What if the reason you can't identify big money flow isn't because you don't know what to look for, but because you're looking at the exact moments when smart money wants you to look? Think about it. Every indicator, every volume spike, every breakout that gets your attention happens after institutional money has already positioned. They don't announce their entries, they hide them. And the entire retail trading industry, all the education, all the tools, teach you to look for signals that only appear after the opportunity is gone. You're not bad at reading money flow. You're just reading the breadcrumbs they leave behind after the feast is over. And I know exactly how this feels. You've seen a stock explode. You've watched it go from $30 to $90 in 3 months. And you look back at the chart trying to figure out what you missed. Where was the signal? When did the institutions get in? And you see the volume spike at the breakout, and you think that's when they entered. That massive volume bar at $50 when it broke out, that must be when the smart money bought. So you make a note. Next time I see volume like that, I'll buy immediately. But here's the problem. That volume spike at the breakout? That's not institutions buying. That's institutions selling to you. That's them distributing their position to retail traders who finally noticed the move. The institutions bought at 32, 33, 35 over weeks and weeks during a boring sideways phase when volume was dead and nobody was paying attention. And now at 50, when everyone's excited and volume is massive, they're exiting into your enthusiasm. This video isn't about complex order flow tools or proprietary software you can't access. It's not about tape reading or level 2 data or dark pool tracking. This is about reading what's already completely visible on the charts you're already looking at. Charts you see every single day, but you've been trained to ignore the most important signals and focus on the noise that comes too late. The core pain I know you're feeling, the thing that eats at you every time you see a massive move happen without you, is this feeling that institutions know something you don't. Like there's insider information, like there are hidden tools, secret indicators, special access that lets smart money see opportunities that are invisible to you. And that feeling of always being late to institutional plays, of always buying what they're selling and selling what they're buying, it's not just costing you money. It's destroying your confidence. It's making you question whether you can ever really compete in this game. But here's the truth that changes everything. Big money flow leaves footprints, completely visible footprints that anyone can see if they know where to look. The problem is you've been taught to look for the wrong signals. You've been taught to look for excitement, for volume, for breakouts, for momentum. All the things that happen after institutions are already positioned, after they're ready to sell to you. This video is going to show you the specific, simple patterns that reveal institutional accumulation during the boring phases when nobody's watching, during the times when the chart looks dead, when volume is declining, when nothing seems to be happening, because that's when everything is actually happening underneath the surface. The myth I need to bust right now, the belief that's probably holding you back more than anything else, is this idea that you need special tools to see institutional flow, that you need level 2 data or market maker information or some proprietary software. You don't. Institutional money can't hide their size. Physics won't let them. When you're moving millions or billions of dollars, you create footprints. You move the market. You absorb supply. You create patterns, and those patterns are completely visible on basic price and volume charts. What they can hide is their timing. They can spread entries over days or weeks. They can make it look random or boring. They can accumulate so quietly that it doesn't create excitement. But they can't accumulate without leaving specific price action patterns combined with specific volume characteristics. And those patterns, once you know what they look like, scream accumulation to anyone paying attention. So what you're going to take away from this video is the exact patterns to watch for, the psychological framework to trust what you're seeing even when it looks like nothing. and the conviction to position yourself early alongside institutional flow instead of chasing it after it's already obvious to everyone. Now let me give you an image that makes this completely clear. Imagine a billionaire wants to buy a rare collection of art. Let's say there are 50 paintings scattered across the world, museums, private collectors, auctions, and this billionaire has decided they want all 50 pieces. They want to own the complete collection. If they walk into every auction and gallery showing their hand, bidding aggressively, making it known that they're buying everything they can get, what happens? Every single price skyrockets. Other billionaires jump in thinking this must be valuable if someone's buying so aggressively. Sellers hold out for higher prices. Museums won't sell at all. The billionaire's own demand, their own obvious interest, makes everything expensive or impossible to acquire. So what does a smart billionaire do instead? They send representatives, different people, spread out over months or even years. Each representative buys 1 or 2 pieces quietly, never showing urgency, never revealing they're all working together, never creating excitement or competition. To everyone watching the market, it looks like random, sporadic buying. Nothing special, no pattern, just normal market activity. But over time, piece by piece, the billionaire accumulates the entire collection at reasonable prices because nobody knew there was a major buyer systematically working through the market. And only after they own 45 of the 50 pieces do they reveal what they've been doing. They announce the collection. And suddenly the last 5 pieces are worth 5 times what the first 45 cost because everyone realizes supply is almost gone and there's massive demand. Institutional money operates exactly this way in markets. They can't show their hand. Their size is their biggest disadvantage if they're not careful. If Goldman Sachs announced tomorrow morning we're buying 10 million shares of this stock, what would happen? The stock would gap up 50% before they could fill a single share. So they can't do that. They have to spread their entries over time. They have to make it look random, boring, unimportant. They have to accumulate during phases when nobody's paying attention. But if you know what quiet, strategic accumulation looks like, if you understand the patterns that reveal systematic buying, even when it's trying to hide, you can see it happening in real time. You can position yourself alongside them instead of waiting until they announce what they've been doing. But here's what nobody teaches you about recognizing this pattern. Here's what every course and book skips over, because it's uncomfortable, and it requires you to completely invert how you think about volume and price action. The accumulation phase, the phase where institutions are quietly buying, looks boring. It looks dead. It looks like nothing is happening. And your brain, which has been trained to seek excitement and action and confirmation, scrolls right past it. Let me give you another image. Imagine fresh snow has fallen overnight. Everything is white and pristine. And you're tracking something big through the forest, a bear, let's say. You're trying to figure out where it is, where it's going, so you can position yourself appropriately, either to observe it or avoid it, depending on your goal. Most people, when they're tracking something, look for the obvious signs. Broken branches at eye level, loud sounds in the distance, fresh tracks in wide open areas where they're easy to see, clear, undeniable evidence that something big came through here recently. And those signs are useful. They tell you a bear was here, but by the time you see those obvious signs, the bear is long gone. You're following a trail that's hours or days old. But experienced trackers, the ones who actually find what they're looking for while it's still there, do something completely different. They look for subtle disturbances that don't make sense unless you understand what they mean. A tree with bark rubbed at a specific height that indicates a bear scratched there. Snow compressed in a particular pattern that shows weight and direction. Silence in an area where there should be birds because the birds know something is nearby that they're avoiding. These aren't obvious signs. They don't jump out at you. They're contextual anomalies. Things that look like nothing unless you understand what they're telling you. But to someone who knows what they're looking at, these subtle signs are more valuable than the obvious ones because they're current. They tell you where the bear is now or was very recently, not where it was yesterday. Big money flow leaves exactly the same type of footprints in markets, not obvious volume spikes that everyone can see. Those are the loud sounds, the broken branches, that come after the bear is gone. But contextual anomalies, specific price behaviors that only appear during quiet accumulation, things that look like nothing to most traders but reveal everything to those who understand what they're seeing. Price holding a support level despite heavy selling pressure everywhere else in the sector. That's a footprint. Tight ranges on declining volume that persist for weeks. That's a footprint. Specific candlestick patterns at the bottom of ranges that only form when buying pressure is quietly absorbing selling. That's a footprint. Quick reversals of breakdowns that shake out weak hands and immediately recover. Those are footprints. These patterns are everywhere. On every chart where institutional accumulation is actively happening right now. But if you're looking for the loud, obvious signs, if you're waiting for volume to spike and price to break out, you'll miss them completely, because by the time those signs appear, the bear is already gone. The institutions are already positioned, and you're tracking yesterday's path while they're already eating today's meal. So, what exactly are those footprints? What are the specific patterns that reveal institutional accumulation before anyone else sees it? Let me break this down into 5 clear signals that you can start looking for immediately on any chart you're watching. The first pattern is what I call the silence pattern, and it's declining volume combined with stable or slowly rising price. Now, this seems completely backward to most traders. They've been taught that rising price needs rising volume to be healthy. That volume confirms price movement, and that's true for trends that are already established and being participated in by everyone. But during accumulation, the opposite is often true. When price is rising on increasing volume, when everyone can see the move and volume is expanding, that's often institutions distributing their position to retail enthusiasm. They're selling to your excitement. But when price is holding steady in a range or grinding slowly higher on volume that gets quieter every single week, something different is happening underneath. It means sellers are exhausted. It means the supply that would normally push price down is being absorbed. And it means someone is quietly buying without letting price run away from them. Look for assets that have been trapped in a sideways range for 4, 6, 8 weeks where volume is progressively declining. Price makes little attempts to break down. Small sell-offs happen, but they're absorbed quickly on relatively low volume. The sell-off starts, a few people panic, and then it just stops. Price bounces back into the range like there's a floor underneath it. That's the footprint of accumulation. Someone is standing there, catching every attempt to sell without letting it cascade into a bigger move down. The key insight that most traders miss is this. Low volume during a range isn't disinterest. It's not the market ignoring the asset. It's often controlled accumulation. Institutions don't want volume. They don't want attention. They don't want other buyers competing with them and pushing price up before they're finished filling their position. They want to quietly absorb all the supply that's available at this price level without creating excitement that brings in competition. So silence during accumulation isn't a sign that nothing's happening. It's a sign that everything is happening exactly as institutions want it to, quietly, under the radar, while you're over there looking at whatever has high volume and big price swings today. The second pattern is what Richard Wyckoff called a spring. And once you learn to recognize this, you'll see it everywhere. It's a false breakdown below established support that quickly reverses back into the range. Here's the setup. Price has been trading in a range for weeks. there's a clear support level where price has bounced multiple times. Everyone can see it. It's obvious support, and then one day, price breaks below that support level. It triggers stops. It creates fear. Weak hands who bought near support panic and sell because their technical level broke. Traders who had stops below support get stopped out automatically. And then, here's the critical part. Price reverses. Sometimes the same day, sometimes the next day. But quickly, strongly, it closes back inside the range like the breakdown never happened. Most traders look at this and think, failed breakdown, false signal, nothing to see here. But it's not nothing. It's everything. It's one of the clearest signals of institutional accumulation you can possibly see. What happened during that spring? Institutions engineered a final shakeout. They intentionally pushed price below support, not because they're bearish, but because they know that breaking support triggers selling. Fear-driven selling from retail traders and mechanical selling from automated stops. And all of that selling creates supply. Supply they want. Supply they aggressively buy. They use your predictable fear response to create the selling they need to finish filling their position. You can see this pattern on any time frame. Daily charts, 4-hour charts, hourly if you're watching closely. The pattern is always the same. Sharp move below support that reverses strongly and closes back in the range. And what's beautiful about this pattern is that it often marks the end of accumulation. After the spring, after that final shakeout absorbed the last of the weak hands, there's usually very little selling pressure left, and that's when price starts to mark up. That's when the trending phase begins. The psychological insight you need to understand here is that this pattern only works because human psychology is predictable. When support breaks, most traders panic. It's automatic. It's how we're wired. And institutions know this. They've studied this. They weaponize your predictable emotional response to create the supply they need. So every time you see a breakdown that reverses quickly, instead of thinking, what a mess, think, who just used my fear to accumulate a position? The third pattern is what I call effort versus result divergence. This is when you see massive volume, like 5 times or 10 times the average daily volume, but price barely moves. In a normal, efficient market, big effort should produce big result. Big volume should create big price movement. When millions of shares trade, price should move significantly in some direction. But when you see days where volume is absolutely enormous, where 10 million shares trade when the average is 1 million, but price closes almost exactly where it opened, that's not random. That's not the market being indecisive. That's absorption. That's someone standing at a specific price level saying, we will buy everything you're selling right here. And they do, all day long. Someone wants to sell 100,000 shares, they buy it. Someone else sells 200,000, they buy that too. The price doesn't drop because every single sell order is being absorbed by institutional buying. Watch for these days. Note them. Mark them on your chart. Because these are the days when ownership is transferring. From weak hands who want out to strong hands who want in. From retail traders who are scared or bored to institutions who have conviction. And often, within days or weeks after you see this kind of volume absorption, price starts moving up. Because the institutions finished accumulating. They got their fill, and now there's no one left to sell at these levels. So price has to rise to find new sellers. The framework to understand here is simple. Effort should produce result. Volume is effort. Price movement is result. When you see massive effort with minimal result, you're witnessing something unusual. And in most cases, during a range or after a decline, that unusual activity is accumulation. It's institutions building a position while retail is providing the supply. The fourth pattern is relative strength during sector or market weakness. This is one of the most powerful signals and one of the easiest to spot if you know what you're looking for. When the overall market is selling off, when there's fear and red everywhere, when indices are down 2 or 3% on the day, watch which individual stocks barely decline. Watch which ones hold key support levels while everything around them is falling apart. Watch which ones show resilience. This isn't luck. This isn't random. This is institutional support. When a stock should be falling with its peers, when the entire sector is down 5%, but this one stock is only down 0.5%, someone is buying that weakness. Someone is protecting a price level. Someone is accumulating on the dip while everyone else is panicking. I want you to create a specific practice around this. During the next market correction, and there will be one, there's always another one coming, create a watch list of stocks that hold up, that show relative strength, that refuse to fall as much as they should. Don't buy them immediately. Just watch them, study their price action, and then when the market recovers, watch which ones lead, which ones break out first, which ones make new highs while the market is still recovering its losses. It'll be the ones that showed relative strength during the weakness, every single time. Because institutions don't accumulate weak stocks. They don't build positions in companies that fall apart during fear. They accumulate strong companies that are temporarily on sale because the market is indiscriminately selling everything. And their accumulation during the fear is what creates the relative strength you can see. The contrarian insight here is that strength during weakness is far more important than strength during strength. Anyone can rise when everything is rising. When the market is in a bull phase, weak stocks and strong stocks all go up together. But holding firm when everything is falling, refusing to decline when there's fear and panic everywhere, that's institutional support. That's smart money saying we're buying this at these levels because we know what it's worth. The fifth pattern is the complete Wyckoff accumulation schematic. Now, I'm not going to make you memorize every phase and every term, but understanding the overall structure helps you recognize where you are in the process. The Wyckoff schematic describes how institutional accumulation unfolds over time in predictable phases. First, there's a selling climax. This is capitulation. Everyone who can be scared into selling does sell. Panic. Volume spikes, price drops hard. Then there's an automatic rally. This is institutions starting to buy the panic. Price bounces sharply off the lows. Then comes the secondary test where price goes back down near the lows to check if sellers are truly exhausted. If the retest holds on lower volume, it confirms selling is done. Then comes the spring, which we already talked about, that false breakdown below support that reverses. And then finally the markup phase, where price starts trending up as institutions push their accumulated position higher and eventually distribute to breakout traders and momentum chasers. You don't need to perfectly identify every single phase, but if you understand this overall structure, you can recognize when you're seeing accumulation behavior. When you see a big sell-off followed by a bounce, followed by sideways consolidation on declining volume, followed by a spring, you know what's happening. And more importantly, you know what comes next. The trading edge here is massive. If you can identify the spring, that false breakdown that reverses quickly, you're entering exactly when institutions have finished accumulating and are about to push price into markup. You're not buying the breakout at higher prices like retail traders. You're buying before the breakout with institutions at prices they accumulated. And then when the breakout happens and everyone else piles in, you're already positioned. You're selling to their enthusiasm if you want, or you're riding the trend with a much better entry than they could possibly get. Now let me make this completely practical. Let me give you the exact steps to start implementing this immediately. Step 1. Build an accumulation watch list. Every single week, probably Sunday evening or Monday morning before the market opens. Scan through charts looking for assets that have been sideways for 4 weeks or longer on volume that's been declining. You're not trading these yet. You're not buying anything. You're just building a list of candidates that fit the silence pattern. Mark the range on your chart. Draw a horizontal line at the high. Draw another at the low, and then just watch. Watch how price behaves when it approaches those levels. Does it bounce off the low consistently? Does it get rejected at the high? Is volume declining each week? You're training your eye to recognize what quiet accumulation looks like over time. Step 2. Track volume anomalies. When you see volume spike to 3 times average or more, but price closes near where it opened, barely moving despite all that volume, note it. Write it down. Keep a simple spreadsheet or journal. Asset name, date, volume compared to average, and what happened to price. Just those 4 things. And then track what happens in the following days and weeks. You're building a pattern library in your own experience. You're creating evidence for yourself that these absorption days actually precede moves. And over time, after you've tracked 10 or 20 or 30 of these, you'll see the pattern clearly. You'll see that most of the time, within 2 to 4 weeks after a major absorption day, price starts moving up, and that builds conviction. That builds trust in the pattern. Not because I told you it works, but because you've seen it work repeatedly with your own eyes. Step 3. Watch for springs on your accumulation watch list. Remember those assets you identified that have been sideways for weeks on declining volume? Now you're watching them closely for that false breakdown, for price to break below the established range low. And when you see it, this is critical. Don't panic. Don't think, oh no, support broke, this is going lower. Watch for the reversal. If price breaks below support and then closes back inside the range the same day or the next day, that's your signal. That's the spring. That's often the final shakeout before markup begins, and this is where you consider entering. Small position. You're testing the pattern. You're learning to trust it through direct experience. Set your stop just below the spring low. If it was a real breakdown and not a spring, you'll get stopped out for a small loss. But if it was a real spring, you just entered at the exact price institutions finished accumulating. Step 4. Relative strength comparison during corrections. The next time the market sells off, and I promise you it will, there's always another correction coming, pull up charts of stocks in the same sector and compare them. Which ones fell the least? Which ones held support while others broke down? Which ones showed resilience? Make a list, and then when the market starts recovering, watch those stocks. They will lead. They will break out first. They will make new highs while the market is still trying to get back to break even. Why? Because institutions were accumulating them during the fear. And now that fear is subsiding, those stocks have less supply above them and more demand underneath them. They're positioned to run. These 4 steps seem simple, and they are simple. The patterns aren't complicated. You don't need special software. You don't need insider information. You just need to know what to look for and have the discipline to track it systematically. But here's the psychological barrier that stops most traders from actually implementing this even after they understand it intellectually. These patterns require you to act during phases that look boring, that feel like nothing is happening. Your brain wants excitement. It wants confirmation. It wants to see big volume and big price movement before it believes something is real. But by the time those things appear, institutions are done accumulating. They're ready to distribute. So you have to train yourself to get excited about boring, to get interested in silence, to position yourself during the phases when your emotions are telling you there's nothing here, move along, find something more exciting. Because that emotional response, that need for stimulation and confirmation, is exactly what keeps retail traders late to every institutional move. We started this video with a question. What if the reason you can't identify big money flow is because you're looking at the exact moments when smart money wants you to look? And now you understand what I meant. You've been trained to look for volume spikes, breakouts, momentum, all the things that happen after institutions are already positioned, after they're ready to sell to you. You learned that institutional money can't hide their size. Physics and market mechanics won't let them. When you're moving millions or billions of dollars, you create footprints. You absorb supply. You hold support when everything else is falling. You create specific price and volume patterns, and those patterns are completely, totally visible on basic charts that anyone can access. What they can hide is their timing. They can spread entries over weeks. They can make it look random. They can accumulate during boring phases that create no excitement, but they can't accumulate without leaving the 5 footprints we covered. Silence pattern with declining volume, springs below support, absorption days with high volume and no price movement, relative strength during weakness, and the full Wyckoff accumulation structure. You saw that the easiest way to identify big money flow early isn't about having better tools or special access. It's about learning to read patterns that most traders have been trained to ignore. The boring patterns, the quiet patterns, the patterns that don't create dopamine hits or exciting stories, but that reveal exactly what institutions are doing while nobody's watching. Now hear this truth and let it really sink in. You're not late to institutional moves because they have information you don't. You're not missing opportunities because you lack access to special tools or data feeds. You're late because you're looking for excitement when institutions operate in silence. You're looking for confirmation when they're building positions during uncertainty. You're looking for loud signals when they're leaving quiet footprints. But the footprints are everywhere, on every chart where accumulation is happening. You just learn to see noise instead of patterns. You learn to get excited by volume when you should have been curious about its absence. You learn to buy breakouts when you should have been positioning during the consolidation before the breakout. But now you know different. Now you understand that silence during accumulation isn't nothing. It's everything. It's institutions doing exactly what they need to do, quietly, systematically, while retail traders are distracted by whatever's loud and exciting today. The reason most retail traders never catch big money flow early isn't because they're not smart enough or don't work hard enough. It's psychological. They need confirmation before they act. They need to feel smart. They need volume and momentum to validate their decision. But institutions are already gone by the time something feels smart and confirmed. They accumulated during the uncertainty, during the phase when it looked like nothing, during the weeks when your friends would have thought you were an idiot for buying. The traders who consistently position themselves alongside institutional money, who catch big moves early instead of chasing them late, aren't smarter than you. They don't have secret information. They're just willing to act on patterns that look boring. Willing to buy during quiet accumulation phases when nothing seems to be happening. Willing to trust footprints over feelings. Willing to be positioned before the excitement, rather than chasing the excitement after it's obvious. And you can be that trader. You can absolutely learn to read the silence. You can learn to recognize springs. You can learn to spot absorption days. You can learn to identify relative strength during market weakness. You can learn to buy what institutions are accumulating before everyone else sees it. But only if you're willing to trade what looks like nothing. Because in markets, that nothing is where everything begins. That's where fortunes are positioned. That's where institutions are building the positions they'll sell to late retail traders at much higher prices. So if this video changed how you see volume and price action, if you finally understand what to look for before institutional moves become obvious to everyone, I want you to do something for me. Share in the comments which of these 5 patterns you're going to start tracking first. Are you going to build an accumulation watch list and watch for the silence pattern? Are you going to track springs? Are you going to note absorption days where volume spikes but price doesn't move? Tell me which one resonates most. And if this showed you that big money footprints are completely visible, that you don't need special tools or insider access, you just weren't looking at the right things, hit the like button. Not for me, for the algorithm. So this perspective can reach other traders who are tired of always being late, who see big moves happen and wonder how institutions knew, who need to understand that the footprints were there all along, visible to anyone who knew what they meant. Subscribe to this channel if you want more frameworks that reveal what's hiding in plain sight. More psychological insights about why retail traders consistently make the same mistakes. More pattern recognition training that lets you see what institutions are doing before the crowd notices. And remember this as you go back to your charts tonight. Institutions can't hide their size. Market mechanics won't let them. When you're moving serious money, you leave footprints. You absorb supply. You hold levels. You create patterns. They can only hide their timing by spreading entries over time and operating during boring phases. But their timing always leaves the same footprints. Always. The silence pattern, the spring, the absorption day, the relative strength, the Wyckoff structure. These patterns have been documented for 100 years. They're not secrets. They're not hidden. They're just invisible to traders who are looking for the wrong things. Learn to read them. Train your eye to recognize them. Build conviction by tracking them over time. And you'll never be late to an institutional move again. You'll be positioned alongside them, accumulating when they're accumulating, ready to sell when they're distributing to breakout chasers and momentum traders who are always late. See you in the next one. Read the silence.